Hi, I am Professor Suneel Maheshwari with Department of Accounting at Indiana University of Pennsylvania. The purpose of this presentation or a brief presentation is to show you how you can use the present value function in Excel to compute the present value of lease obligation when a lease is classified as a capital lease. So we'll go through a couple of examples and just use the present value function from Excel and show you each and every item how it needs to be filled. Generally, when a lease is classified as a capital lease, it is paid over. You have to pay the lease obligation over a number of years. So in this case, you have got a capital lease and you need to make an annual payment of $25,000 over a 6-year lease term, with the first payment on January 1st at the lease's inception, and the interest rate is 5%. Generally with the leases, you'll find that the payment is received or payment is made by the lessee at the beginning of the period. If lessee's fiscal year is the calendar year, what would be the pre-tax amount related to the lease that the lease would report in its income statement for the first year ended December 31st? So one option is basically, as you do using a present value table, and you can present value of an annuity table, you can do that. The other option is you can do it in Excel. You just type in equal to in any cell, type in PV, and it will pop up this formula in that Excel sheet, which reads rate, NPER, PMT, FV, and type. Now, rate is the rate which was shown at 5%. That is the rate at which you are paying the interest. And number of periods in this case was 6. And annual payment was $25,000. There is no need to enter, there is no future value we are looking at, so that is 0. And since the payment is to be made at the beginning of the period, or you enter 1 in the type. It would be 0 if the payment is made at the end of the period. So you just type in equal to present value 5%, 6 for the number of periods, 25,000 for the payment made every period, 0, and then 1 for the indicating that payment is made at the beginning of the period. And it will just hit enter, and it will give you 133,236.92 or 133,237 approximately. So it's a very simple way to find a present value of the lease obligation. Here is another example where manufacturer Southern leased a high-tech electronic equipment on January 1, 2016, and it was purchased at a cost of $112,466. Lease term is 2 years and 8 quarterly periods. So payment of $15,300 is made at the beginning of each quarter. So there are 8 quarters. If you decide there are 8 quarters, then the implicit interest rate of 10% will also be divided by 4. So your implicit interest rate in this case will become 2.5%. Economic life of the asset is 2 years, and that's where the 8 quarters or 8 periods are coming from. And fair value of the asset at $112,446. So how did we come to $112,446? Is you got the present value formula. You take 2.5% for 8 periods, 2.5% because your 10 was divided by 4 for the 4 quarterly payment for the year, and $153,000 was the annual payment, 0 for future value, and then type 1 for payment at the beginning of the period. And if you hit the enter, you'll get $112,446 or $12,445.68 to be exact, as the present value of that asset. So there could be another application of the present value formula. Sometimes you might find that there is a missing periodic payment for the lease. And to give you an example, American Services leased a packaging machine for about $4.8 million fair value, or the present value of the lease payment. The machine and the payment was to be made at the end of each year. The useful life of the machine is expected to be 6 years with no residual value, and the implicit interest rate was 9%, which was American Food Services incremental borrowing rate as well. So in this case, the annual payment is missing, equal annual or annuity payment is missing. So we can still use the present value formula to find that annuity payment. So to do that, you need to find the present value of the annuity factor and then divide the fair value of the lease by that annuity factor to find the periodic payment. Generally, you would have looked up in a present value table for that period. So in this case, the interest rate is 9%, number of payments were 4, and we have taken $1 as the payment and then 0 because it is at the end of the period. And when you find the present value of the $1 for 4 periods, it will give you the present value factor of 3.2397. That is basically, again, the same number you will get for when you look at a present value of the annuity table at under 9% for 4 periods. So in this case, this represents the present value of $1 received each year at the end of every year for 4 years, given the discount rate is 9%. The present value of those 4 payments together is 3.2397. So to get the present value, now you can take the present value of the lease, which was $4,800,000, and divide it by the present value of the annuity factor, 3.2397, to get a annual lease payment or the periodic lease payment of $1,481,610 in this case. Thank you very much for listening to the presentation. Have a nice day.